Welcome back. The topic for the day is pricing decisions. So the annual day is coming up in your neighborhood, and your next door neighbor has asked you for a small favor. Let's check out his request.
I'm going to put up a cheesecake stall. Could you help me in fixing the selling price?
What an adorable neighbor you have. You should definitely help him to fix his selling price so that he gets the maximum profits. Let's check out the details. So the first method that we will be studying is the tabular method. So the price and the quantity demanded is given. So if you notice here, when the price is $10, the quantity demanded is 0. And when you reduce price by $2, then there is a jump in quantity to the tune of 5 units. And again, when the price has been reduced to $6, that is a $2 reduction, the quantity has again jumped by 5 units. So every $2 reduction in price leads to a 5-unit increase in the quantity demanded. And fixed cost is $1. So we will take the total fixed cost as $1 for that particular day. This boy has to pay $1 to the Residents Association for setting up a stall. So this $1 he has to pay irrespective of the quantity that he sells. So it is a fixed cost. And the variable cost per unit is $1.2. Now we have to find out which is the best price which will give him the maximum profit. So what is profit? Profit is nothing but total revenue minus total cost. So under the tabular method, all that we have to do is find out the total revenue for each price and find out the total cost for each price. Find out the profit. The price which gives the maximum profit should be selected as the optimum price. So let's add the columns. So we have the total revenue and the total cost and the profit. Profit is nothing but total revenue minus total cost. So how do we find out the total revenue? Total revenue is nothing but the price multiplied by the quantity. So in order to find the total revenue, you have to multiply the first column with the second column. So you get the following figures, that's 10 into 0, 0, 8 into 5, 40, and so on. And what is the total cost? Total cost is nothing but you have a fixed cost of $1 and you have a variable cost of $1.2 per unit. So the total cost for the first price quantity combination will be $1, that's the fixed cost, plus $1.2, that's the variable cost per unit, multiplied by 0. That is the number of units that we are selling, because the quantity that we are selling in the first price output combination is 0. So we get the total cost as $1. So we write that under the total cost column. Now moving to the second price quantity combination. That is, if you are selling at a price of 8, then the quantity demanded is 5. So what is the total cost? It is $1, which is the fixed cost that you have to pay to the association, and $1.2 per unit, which is the variable cost. And how much quantity are we selling? We are selling a quantity of 5. So multiplied by 5, we get $7 as the total cost. So we make a note of it in the total cost column. So we can adopt the very same method to fill up the total cost column, that is fixed cost plus variable cost of $1.2 per unit multiplied by the number of units. So further down, you have these units. So each time you substitute the respective units, you will get the total cost figures. So the total cost works out to 13, 19, 25, and 31 for the balanced price quantity combinations. Now coming to the profit. What is the profit? Profit is nothing but total revenue minus total cost. So all that you have to do is this column, that's the total revenue column, minus the total cost column, you will get the profit. So the profit works out to the following figures. Now check for yourself, which price quantity combination gives the maximum profit? The maximum profit is $47 and the price quantity combination is 6 and 10. That is, when you are selling at a price of $6, the quantity that you can sell is 10 units and you get the maximum profit of $47 in total, which means that under the tabular method, the profit maximizing price is $6 that's coming from here. And the profit maximizing quantity is 10 units that's coming from here. So we got the final answer under the tabular method. Now think for yourself. Should we always calculate the total revenue, the total cost, and then calculate the profit to find out the best price quantity combination? It's not required. So what is the alternative? Now suppose if you are selling one more cheesecake, you get $2 additionally. Okay. And the cost of making this cheesecake is just $1. So you definitely have a profit for each additional unit that you sell, correct? 2 minus 1. $1 is a profit that you get. Each time you sell an additional unit, your profit will increase. So you can sell as long as this additional revenue is more than the additional cost. Now, as per our example, you're getting $2 as additional revenue and $1 as additional cost. And this additional revenue and additional cost is known by a name. What is that name? It's nothing but the marginal revenue and the marginal cost. What do you mean by marginal revenue? The extra revenue that you get if you sell one more unit. And what do you mean by marginal cost? The extra cost that you incur for making one more unit. So if the marginal revenue is greater than the marginal cost, you will definitely be making profit. So you can go on selling as long as the marginal revenue is greater than the marginal cost. And if the marginal revenue is lower than the marginal cost, then for each additional unit sold, your profits will start reducing. So at what price quantity combination will our profit be maximum? You can answer that question. Simple, right? When marginal revenue is greater than marginal cost, the profit starts increasing. And when the marginal revenue is lower than the marginal cost, the profit starts reducing. So what is the point at which the profits are at its peak? It is at the point where marginal revenue is exactly equal to the marginal cost. So if you can find out the price quantity combination where the marginal revenue is exactly equal to the marginal cost, you will get the maximum profits. Now, what we are planning to do is find the price quantity combination where the marginal revenue and the marginal cost are equal. So I have added one more column, that is the marginal revenue column. And what do you mean by marginal revenue? Marginal revenue is the revenue that you earn from one extra unit. So how do you find out? It's the change in total revenue indicated by delta TR divided by change in quantity. And we know that the profit maximizing price and quantity is where the marginal revenue is exactly equal to the marginal cost. So first we will calculate marginal revenue. Now look carefully at this table. When the quantity increased from 0 to 5, that is when the quantity jumped by 5 units, the total revenue jumped by $40, which means that the increase in revenue per unit is 40 divided by 5 or $8 per unit. So that's the marginal revenue. Now moving forward, when the quantity jumped from 5 to 10, that is an additional 5 units were sold, the total revenue jumped from 40 to 60, which means that there is an additional revenue to the tune of $20. So what is the additional revenue per unit? Or what is the marginal revenue? It's 20 divided by 5 or $4 per unit. Now moving forward, it is 0. That's the change in total revenue. That's what is written here. And the change in quantity is 5. So 0 divided by 5, the marginal revenue is 0. And next, the total revenue dropped from 60 to 40, which means that there is a drop in revenue. That's negative 20 is the change in revenue. And the change in quantity is plus 5, which means that the marginal revenue or the increase in revenue per unit is given by negative 20 divided by 5 or negative 4. Moving forward, 40 to 0, the change is negative 40. And from 20 to 25, it is plus 5 units. So the marginal revenue is minus 40 divided by 5, giving an amount of $8 negative per unit. So the marginal revenue part is complete. Now, what do you mean by marginal cost? Marginal cost is the cost that you incur for making one more additional unit. What is the amount? It's nothing but the variable cost per unit, because the fixed cost will remain fixed irrespective of the number of units we make and sell. So the only cost that is going to increase if we make one additional unit is $1.2 per unit, which is nothing but the variable cost per unit. So variable cost and the marginal cost are one and the same thing. So we have the variable cost at 1.2 per unit. And if you can find the price output combination where the marginal revenue is also 1.2, then that's the best price output combination. So do we have 1.2 here? No, we do not have 1.2 here. We do not have a price output combination where the marginal revenue is exactly equal to the marginal cost. So this is actually a disadvantage of the tabular method. We can find out the marginal revenue only for the price quantity combinations that are given in the table. Maybe there are certain other combinations, like if you sell 11 units, maybe it will give a higher marginal revenue. But unfortunately, we cannot calculate that with the tabular method, because under the tabular method, only specified price output combinations are given. So we know that profit maximizing price and quantity is marginal revenue is equal to marginal cost. But unfortunately, there is no such combination where both are exactly equal. So what is the next best alternative? We will take the combination where the marginal revenue is just greater than marginal cost, because that's the best solution that we can arrive in this particular circumstance. So marginal cost, we know it is 1.2. That's nothing but the variable cost per unit. And marginal revenue, we will select the marginal revenue, which is very close to 1.2, but it is more than 1.2. Which is that marginal revenue? It is $4. That is a marginal revenue which is greater than the marginal cost and which is very close to the marginal cost. If you go to the next option, it is 0. It is less than the marginal cost. So we cannot take that option. So based on the available information, the best price quantity combination according to the tabular method is when we sell at a selling price of $6 and we are able to sell 10 units in total, giving a profit of $47. Now, I already said that we could not find the price quantity combination where the marginal revenue is exactly equal to the marginal cost. That's actually a disadvantage of the tabular system. So according to the tabular method, the profit maximizing price is $6 per unit. That's coming from here. And the profit maximizing quantity is 10 units. Now we will plot these points in a graph so that you will be able to conceive this concept much better. We will be plotting the quantity, that is this column on the x-axis, and the total revenue and the total cost, that is these two columns, will be plotted on the y-axis. So we will first plot the total revenue. That is, focus your attention only on these two columns. When the quantity is 0, the total revenue is 0. So I will mark that point with a red cross. And when the quantity is 5, the total revenue is 40. So that's here. When the quantity is 10, the total revenue is 60. When the quantity is 50, the total revenue is 60. When the quantity is 20, the total revenue is 40. And finally, when the quantity is 25, the total revenue is 0. When we join these lines, we get the total revenue curve. Now coming to the total cost curve. So we are going to plot the quantity on the x-axis and the total cost on the y-axis. So the first plot is 0, 1, that comes here, indicated by the blue cross. And the second plot is 5, 7. The third plot is 10, 13. Fourth plot is 15, 19. Fifth plot is 20, 25. And last plot is 25, 31. We join the line to get a perfect straight line, which is the total cost curve. And why is the total cost curve a perfect straight line? Because the rate of change is constant. And what is the rate of change? The rate of change is nothing but the variable cost of $1.2 per unit. That is why you are having a straight line for the total cost curve. And for the total revenue curve, the revenue first increases, reaches its peak between 10 and 15 units, and then it drops. Now, what is total revenue minus total cost? That's nothing but the profit. So now we will take the profit maximizing quantity that we had found out earlier, 10 units. That's here. So what is the profit made at 10 units? It is indicated by the dotted arrow because profit is a difference between total revenue and total cost. So at 10 units, we will get a profit of this much. This much means it's equal to $47. But can you say that $47 is the maximum profit? Look at the graph carefully. It's curving upwards, which means that there could be a point here where the profits are much higher than this 10 units. So there could be a point in between 10 and 15 units where we get a much higher profit that is much more than this $47. And how do we find that? We can find that only through formulas, and that is known as algebraic method. Now, the algebraic method is based on formulas. And when can we apply formulas? We can apply formulas only when there is a pattern that is existing between the variables. And in this case, if you see here, when the price drops by $2, the quantity increases by 5 units, which means that there is a pattern existing between the price and the quantity demanded. Only if there is a pattern can we adopt the algebraic method, or we have to resort to the tabular method. And the principle on which the algebraic method is based is marginal revenue should be equal to the marginal cost. Now, the first formula that you have to learn is the demand equation given by P is equal to A minus PQ, where P is the price, A is the selling price when quantity sold is equal to 0, B is the change in price divided by change in quantity, and Q is the quantity sold. So this is the formula of the demand equation. And the second formula that you have to learn is the marginal revenue equation. Marginal revenue is A minus 2BQ. So the only difference between the demand equation and the marginal revenue equation is that there is a 2 in front of BQ. All the other things remain the same. Now with these two formulas, we are ready to apply the algebraic method. So I have just copied the two equations that we need for tackling questions under the algebraic method. Now in the question, they will not give the entire table because that's not required, because already there is a pattern or there is a linear relationship which is existing between the price and the quantity. So in the question, you will have just two price and quantity combinations. So I'm just going to retain two price and quantity combinations. So we need only this much. So only these two informations will be given in the question. You will not have this or you will not have this. That is, you will not have a full table. And the next detail that will be given in the question is fixed cost and the variable cost per unit. Now, first we will focus on the demand equation. Our first target is to calculate B. And what is B? B is nothing but the change in price divided by change in quantity. So what is a change in price? 4 minus 2 is 2. And what is a change in quantity? 15 minus 20 is 5. You don't need to take the negative sign here. That is 15 minus 20. I know it is negative 5. What we are trying to find out is the rate of change where negative sign is not required. So all that you have to do is subtract the two prices and you have to subtract the two quantities, ignoring the minus sign. So the value of B is 2. That's coming from here, and divided by 5, that's coming from here, which gives an amount of 0.4. Our next task is to calculate A. And how do we calculate A? We know that the demand equation is P is equal to A minus BQ. We already know that B is 0.4. And we know two price quantity combination. So we can take any of the two price quantity combinations. So we have the price, we have the quantity, and we know B. So the only unknown will be A. So we can very easily find A. Let's start substituting the figures. So the demand equation is P is equal to A minus BQ. So I am going to select this price quantity combination. That is, price is 4 and quantity is 15. So I have substituted the figure, price 4, quantity 15, and B it is 0.4. So solving this, we get the value of A as 10. So if you notice here, A is the selling price when quantity sold is equal to 0. See this? The blurred figure, the price when the quantity is 0. So we've got the right answer. Now, once we know the values of A and B, it means that our demand equation is complete. P is equal to 10 minus 0.4Q. 10 is the value of A and 0.4 is the value of B. And since we've got the demand equation, it is very easy to find out the marginal revenue function because the only thing that you have to add is a 2 to the demand equation. So what is the marginal revenue function? Marginal revenue function is 10 minus 0.8Q. And how did I get this? Because we know that A is 10 and we know that the value of B is 0.4. So substituting those figures, we get the marginal revenue function as 10 minus 0.8Q. So we are done with the marginal revenue function. And what are we equating? Marginal revenue is equal to the marginal cost. And what is a marginal cost? Marginal cost is nothing but the variable cost. Variable cost they have given as 1.2. So marginal cost is also $1.2. Now we've got all the information to find out the optimum price and the optimum quantity. The three details which are required are the demand equation, which we found out, the marginal revenue function, which we found out, and the marginal cost also has been noted down. So the three details that are required for finding out the answer, that's the demand equation, the marginal revenue equation, and the marginal cost figure. I shall copy it into the next slide. Okay, so that's done. And what is our next step? We have to equate marginal revenue to marginal cost. Why? Because we know that the profit is maximum when marginal revenue is equal to marginal cost. We already have the details for marginal revenue. What is marginal revenue? 10 minus 0.82. And what is marginal cost? Marginal cost is $1.2. That's nothing but the variable cost. So it is 10 minus 0.8Q is equal to 1.2 minus 0.8Q is equal to 1.2 minus 10. And we find Q that's equal to 11 units. So the quantity at which the profits are maximum is equal to 11. Now it is very easy to find out the price because price is equal to 10 minus 0.4 into Q. We already know the value of Q. So substituting the value of Q in the demand equation, we get 10 minus 0.4 into 11, or the best selling price is $5.6. So the profit maximizing price is $5.6 per unit. And the profit maximizing quantity is 11 units. Now, in the question, you might also be asked to find out what is the maximum profit that you get when you adopt a selling price of $5.6 and when you sell 11 units. So how do we find out the profit? Profit is nothing but total revenue minus total cost. And what is the total revenue? Total revenue is nothing but the price multiplied by quantity, correct? So we already know the price, we already know the quantity. So what is the total revenue? Total revenue is 5.6. That's the selling price that we have adopted. And 11 is the number of units that we can sell. So we get a total revenue of $61.6. And now we have to calculate the total cost. What is the total cost? In the question, they have said fixed cost is $1 and the marginal cost is $1.2 per unit. And we are selling 11 units. So what's the total cost? It's fixed cost $1 plus variable cost per unit, which is $1.2 per unit, multiplied by number of units, that is 11. So the total cost amounts to $14.2. And what is the profit? Profit is nothing but total revenue minus total cost, that's 61.6 minus 14.2. We get the maximum profit as $47.4. So under the algebraic method, what did we first do? We first calculated B, then we calculated A. Once we know B and A, we can write the demand equation. And from that, we can easily write the marginal revenue function. And then we have to calculate Q by equating the marginal revenue and the marginal cost. And then finally, you calculate P. So the order is B, A, Q, P. So let's do a final recap of the two methods. The first method was a tabular method And the second method is the algebraic method. So under the tabular method, you have to use it when there is no linear relationship that exists between the price and the quantity demanded. I said earlier that you can use the algebraic method, or you can use formulas only when there is a pattern or when there is a linear relationship between the price and the quantity. If no such linear relationship exists, then we are forced to use the tabular method. And what are the steps? First, you have to calculate the total revenue and the total cost for each of the price quantity combinations. So in the table, for each row, you have to calculate the total revenue and the total cost. And we know that profit is equal to total revenue minus total cost. You have to select the price quantity combination that gives the maximum profit. Now, the algebraic method can be used when there is a linear relationship that exists between the price and the quantity. And usually in the question, there will be two price quantity combinations which are given. And the formulas that we need to know are, one is the demand function, which is given by P is equal to A minus BQ, where P is the price, A is the selling price when quantity sold is equal to 0, and B is the change in price divided by change in quantity, and Q is the quantity demanded. And the marginal revenue function is given by MR is equal to A minus 2BQ. And the steps that have to be adopted are, first calculate B, that is change in price divided by change in quantity. And how do we find out the change in price and change in quantity? From the two price quantity combinations that will be given in the question. Then you have to calculate A using the demand function P is equal to A minus BQ. Now we have already found B in step 1, and then you can take any of the given price quantity combinations which are given in the question. Once A and B is known, the demand function is complete. And as an example, you could say the demand function will be P is equal to 10 minus 0.4 into Q, where 10 is A and 0.4 is B. Now, once you have the demand equation, it is very easy to form the marginal revenue equation, because the only difference is you have to multiply it with 2. So the marginal revenue function will be 10 minus 0.8Q. That is, we are just multiplying 0.4 with 2. And the next step is to find out the Q, or the quantity. And how do we find that out? By equating the marginal revenue and the marginal cost. The only unknown will be Q. So it is very easy to find out Q. And once you have found out Q, then the next step is to find out P by substituting the value of Q in the demand equation. Now, in the question, they might further ask you to find out the maximum profit. And what is maximum profit? That is nothing but the total revenue minus the total cost. And what is total revenue? Price multiplied by quantity. And what is total cost? It is a fixed cost plus the variable cost per unit multiplied by quantity. So I will show the two recap slides once again. I request you to take a screenshot so that it will be very easy for you to revise on the eve of the examination.